Welcome to Informed Investor. Zomato, a name synonymous with food delivery in India, has recently served up a plate of disappointing results. The company's third quarter results for fiscal 25 have sent shockwaves through the market, with investors scrambling to digest the news. Share prices of Zomato have taken a significant hit, dropping by almost 10% today. So what exactly is going on with Zomato? Stay tuned till the very end to know it all. Now, to start off, let's do a quick overview of Zomato. Zomato is a leading food discovery and delivery platform that has revolutionized the way we discover and order food. Founded back in 2008 as Foodie and rebranded as Zomato in 2010, the company has grown into a comprehensive food tech company with a diverse range of offerings. Zomato's platform connects customers with restaurants, enabling them to search for restaurants, read reviews, view menus, order food online, and book tables. Additionally, Zomato provides a range of value-added services for restaurants such as marketing tools, delivery services, and procurement solutions. Now, in terms of key businesses, Zomato's business can be divided into the following. Food delivery is spread across 800 plus cities and contributes around 42% of the revenue. Quick commerce, which is ideally done through Blinkit, is on-demand delivery of thousands of products across multiple categories within 15 minutes. Next is going out, which comprises dining out across restaurants, and Zomato Live, which includes discovery and ticketing of events such as food carnivals, music concerts, and other live events in India. Lastly, there is B2B, which is hyper pure, providing food ingredients, veggies, meat, and other products. Now, Zomato's revenue is primarily driven by food delivery, which accounts for 42% of the total revenue, reflecting its core business. Quick commerce contributes 24%, highlighting Zomato's expansion into rapid grocery delivery. The B2B supplies hyperpure segment follows closely at 29%, emphasizing Zomato's growing role in the food supply chain. Smaller segments like going out 5% and others 0.1% show the company's diversification efforts. Overall, food delivery remains dominant. Now, moving on to the Q3 results. Zomato reported a mixed bag of performance indicators. Talking about the top line, Zomato reported a 64% increase in revenue from operations to 5,405 crores in the Q3 of fiscal 25 compared to 3,288 crore in the previous year. The company's total expenses rose significantly by 64% to 5,533 crore due to heavy investments in its quick commerce arm Blinkit and other operational costs. When we look at the adjusted EBITDA, it grew 128% year-on-year to 285 crore in the third quarter of fiscal 25, largely driven by improvement in food delivery. However, on a quarter-on-quarter basis, EBITDA declined 14%, or rather 45 crore. Now, lastly, despite the impressive revenue growth, Zomato's net profit fell drastically by more than half, by 57% to 59 crore from 138 crore a year ago. Now, what about the segmental performance? Food delivery, which is a core business of the company, rose to 2,413 crore in Q3, an increase of 17% year-on-year and 3% sequentially. Talking about Zomato's quick commerce business, which is its Blinkit, saw its revenue increase by 117% from last year and 21% sequentially. Another notable performance was the going out segment, which includes dining out and event ticketing, saw a 255% increase compared to last year. Now, the contrasting trends of rising revenue alongside falling profits can be attributed to several factors. Zomato's significant investment in expanding Blinkit in order to expand their dark store operations has led to increased operational costs. In fact, Zomato aims to get to 2,000 Blinkit stores by December 2025. Now, the quick commerce space is becoming increasingly competitive. Zomato faces pressure not only from existing players like Zepto, DMart, Flipkart Minutes, Swiggy, but also from new entrants like the potential entry of Amazon that could potentially impact Blinkit's market share and profitability. Lastly, although food delivery revenue grew, there was a noted slowdown in demand towards the end of November 2024. The gross order value growth in the food delivery business was only 2% higher on a sequential basis. The slowdown in food delivery, which is the highest contributor to revenue, has affected overall growth expectations and profitability margins. Now, what do the brokerages have to say? Following the disappointment results, brokerages have expressed mixed views on Zomato. Jefferies remains optimistic about Blinkit's execution and Zomato's expansion, expecting Blinkit to double its store count to 2,000 by December 2025, a year ahead of schedule. However, it trimmed Zomato's target price by 7% to 255, retaining a hold rating due to a sharp decline in its bottom line. Likewise, Bernstein is optimistic about Zomato's aggressive Blinkit expansion and praised its food delivery margins expected to stabilize at around the 5% adjusted EBITDA. It reiterated an outperform rating with 310 target, citing the recent stock correction as competition driven. Lastly, Novama noted Blinkit's faster than expected dark store addition, boosting growth but impacting short-term profitability due to upfront costs. It expects stronger profitability as stores mature, cutting Zomato's target price by 8% to 300 while retaining a buy rating. Now to conclude, Zomato's Q3 FY25 results paints a complex picture of a company experiencing rapid revenue growth while grappling with significant challenges that have impacted profitability. The aggressive expansion of Blinkit is a double-edged sword. It holds promise for future growth but has led to immediate financial pressures. Investors should keep an eye on how Zomato navigates these challenges and whether its strategic investments will eventually translate into sustainable profitability. Now, having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.